All right. Good afternoon, traders. Some of you, good afternoon again. If you just came to the trading room, good. You know what? Just an intro slide, Phil. Good afternoon to you. Hello. Thank you, as always. Yes, I've got my active investor workshop slides. You can see today we're talking about leaps. Anything and everything. I don't have actual presentation slides, so we're just going to jump in to the trading platform. We'll show where you find leaps, quote unquote. I say quote unquote because leaps, it's always funny, right? Because you're like, what does leaps even mean? Long-term equity anticipation. The P is for patient in leaps. A lot of people didn't realize that, but the P is for patient in anticipation. Patient securities. What does that mean? It means long-term options. That's all it means. There is nothing special other than the fact that it used to be there was more, right? It used to be that, there was either 4 or 6 options available. 10 years ago, 15 years ago, that was it. Maybe 15 now. I don't know. I'm trying to remember. But they had 4: front month, second month, and then a leapfrog or 2. And then if they had January and January, those were your leaps, Januaries. Now, I mean, anything longer than a year, technically, right? So any option longer than 12 months. I actually think anything longer than maybe 6 or 7 months for me is something I would consider long term, right? Like, when was the last time as a trader you took a trade and stayed in it for months and months and months? Okay, I mean, so right off the bat, we know this is a little different than just like a swing trade per se, right? Like, why do I need a leaps contract, a long-term contract, if I'm just swing trading? You don't. It won't benefit you. You're paying extra and losing leverage for no reason, quite honestly. So if you're going to be trading for 7 to 10 days, 2 weeks, and you know that's the case, you don't need to buy leaps contracts. Unnecessary. So it's just not helping you. What then do we tend to use leaps for? And the answer would be a stock replacement strategy, typically, right? You're probably not buying stocks for your swing trades. Maybe you are. And if you are, certainly there is some potential, I guess, for them to replace anything you're using stock for. Leaps works out perfectly. So if you're trading stock now, you could trade leaps instead. If you're buying stock to sell covered calls, which is a great income strategy, you'll hear people say covered call on steroids. It's not a covered call. It's a diagonal spread. Instead of owning the stock, you own a long-term contract and still have the ability to sell short-term out of the money contracts against it. So it's a leveraged covered call type strategy. So there it is. That's what we're talking about. I'm Scott Beck. I'm the head trading coach here at Tradespoon. I've been trading for going on 23rd year, actually. Teaching for almost 20 of those years. That's me. 19, going on 19 of those years. That was a lie. That was a misstatement. I do need to remind you, I'm going to go through these specifically since this is once every other week, that trading and options in particular can involve substantial risk, may not be suitable for all investors. Please read characteristics and risks of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risks. Be willing to accept them in order to trade in these markets. Tradesmen and myself are not investment advisors. Not registered with the SEC or FINRA, should not be assumed that future trade picks will be profitable, equal past performance. It shouldn't. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and/or the team of Tradespoon may have a financial interest in the securities presented on the trade picks. Vlad Karpel, Tradespoon founder, is also an investor and consultant of AOS Inc., which does business as Trading Block and Money Block, a FINRA and SIPC member broker-dealer firm. Tradespoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. Okay. Give me 1 second here. All right. I'm going to bring up trading platform, and we're going to start here. Whoops. We're going to start here. So let's go into but here's one thing I would say. So the first thing I would say is this: if you are thinking longer term, if you're thinking leaps, this is not the right. Well, this is definitely not. This is the 1 minute chart. Oh, look at the buyers came in right at the end, almost got it back where we wanted it. This daily chart is really not that relevant to me. If you're going to be trading for the swings, leaps is not really what you need. If you're holding through the swings, then this is not your perspective, this daily chart. You're holding, you're investing more. So you're going to look more at like a chart like this, which is you can see here, this is a 3-year weekly chart. I say this a lot in my trading room when we're analyzing what we think the market is. Whatever you might think about this market, if you look at it at this perspective, the trend is still intact. It's a bullish trend that is intact. So what are we looking for now? Well, this is actually, if you're long term, this is what you would be looking for. You don't want to buy in at these highs and then be like, what have I done? You want to wait and see. So long term, very simple signal could be applied. Let me make sure this is, you can go back in time and you can see that this is just a pretty consistent methodology, even back to the pandemic. Now, even when they're a little higher up, you can see this type of a signal for a longer term is pretty accurate. So the first thing I would say is make sure that what you're using to produce a signal that says let's trade. Technically, this would have been viable back here. You just would have needed to have closed it. And we definitely looked at the pandemic as a reason to shut a bunch of things down. So we were pretty on top of that if you were with me back then. That's a great one there. But you can just see over and over again, this signal can play out. Now, we want to make sure that we have something that says now's the time to take long-term trades. And you can see that over and over and over again. So if you're a long-term trader, certainly you want to have something that you look for. And if you notice, we're very, very close to something here. If you're using, I'm gonna leave this up for 1 second. Give me 1 minute here. So we talked about what is a LEAP? It's a long-term equity anticipation security. Depending on the definition, more than 12 months. I think anything more than 6 or 7. Something that is a longer term holding, something that's not a swing trade, right? So what is it? Something longer term. Okay, what do you need it for? For longer term trades, whatever that might be for you. But if you're using the longer term trades, if you're looking to tie up more money, you definitely still have to have a set of criteria that you're using to indicate when and how to trade. And you'll notice we're kind of waiting. This could be a week or 2 away from giving long-term signals. This is the SPY. If the SPY is long-term giving signals, I could put the QQQ on here and see if it matches up. Pretty close, right? Not 100%, sometimes a little earlier, sometimes a little later, but for the most part, those signals are going to come all around the same time. If there's a particular stock, let's see what Tesla would have looked like for longer-term trades. And you can see a lot of similarities. There might be a couple of extra signals that come here or there, but if you're trading for the long term, make sure you have your criteria. What stocks are you watching for the long term? Is it ETFs? Is it market leaders? So you should have a watch list with its own criteria that then you wait for signals. Once a week. I mean, honestly, you could do this work on Sundays. You could do it Fridays. It's up to you. But the simple fact is, if you're trading LEAPS just because it exists, it's wrong. That's wrong. Trade it because you have a reason. What's your reason? Because I'm longer term. Because I want to get into something and hold it and maybe sell short-term options here or there if I can. Or just simply ride the leverage that it gives you. If you're buying LEAPS, anytime you're a buyer, you are Vega positive. What does that mean? Vega positive. So if you're trading options, you definitely want to get comfortable with the Greeks. So that's something that I speak about quite regularly. So Vega is how your option behaves relative to implied volatility. If implied volatility goes up, you make money. You're a buyer. You want to buy it when it's cheap. And if they pump value in, even better. Now, couple of interesting facts about longer term options. Number one, the further out you go, the more sensitive they become to changes in implied volatility. So time makes it more sensitive. So you would expect a bigger Vega. But when we analyze implied volatility, we typically see like here on my chart, when you see implied volatility, you're typically seeing like front month volatility. And so, yes, I would expect my LEAPS to be more sensitive to changes in implied volatility, but I would expect those changes to be much less. I'm not expecting a 20 or 30 point move on the back end options, maybe only 15 or 20. So it's going to be more muted. So there's just some interesting characteristics about them that we want to be aware of. Your theta, when you buy an option, your theta negative, period, right? You will lose money from time, of course. But you're buying a lot more time. So essentially you look at it as buying it in bulk. So it's cheaper, right? So the amount of time you lose per day on an option like this is going to be significantly less than what you see if you're used to buying options that are 4 to 6 weeks out. So your theta on a daily basis, you pay a lot more for time overall, of course, right? Because buying 18 months versus buying 4 or 5 weeks, very, very different. But if you looked at it as like per week, it would be significantly less, right? So why do you do it? You do it so that not because you necessarily think you're going to hold the trade all the way till expiration. That's never our thought, right? When I talk to people about expiration, I'm like, okay, we're looking out in March. So like, I'm not looking to hold it to March. That's not what, we don't buy the option that we think we're going to hold until. Then you're always running out of time. We buy whatever we need plus some to make sure that we don't run out of time, to slow down the time to give. The last week or two is when theta really ramps up. So our objective should be, if you're an option buyer, try not to be in the option in the last 2 weeks of expiration, right? So if you're short-term trading, that's your thought process. Long-term, if I were to buy, January's, that doesn't mean, oh, I'm definitely holding till January. It means I've got the ability to. Even from this chart here, you can see there's plenty of times where you think, man, I would have liked to have just taken my profits, got out, and then looked to get back in. Now the trades last longer, right? Those trades might last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, somewhere in there. Same number of periods, right? When we use the daily chart, we're thinking somewhere between 7 and 12 days. When you use the weekly chart, it might be between 7 and 12 weeks. And instead of exiting the trade, what you might decide to do is then, remember what I said, covered calls, right? What would make me want to sell a covered call? When I think time and or price are going to go in my direction. So let me get a different colored line here. Hello, Ed. Ed says, I'm a delta. Well, we'll talk delta. Delta is price movement, right? Those are the big ones. Delta, theta, Vega. Those are the big three right there. Delta, theta, Vega. So how does it react relative to price? How does it react relative to time? How does it react relative to volatility? Those are the core variables, right? Gamma just tells you how much will it accelerate? How fast will delta move up or down? Rho is interest rates, if you were ever interested in that. Good stuff. Okay, now what if I were thinking that anytime it was overbought and then it went sideways or down, then I could sell a covered call, like here, or here, or here. Now remember that a covered call really might only be 4 or 5 weeks, so we're not looking for a long, we're just looking for little pullbacks. And you can see that we're trying to see, can we catch these areas where on the pullbacks, maybe I'm able to sell some covered calls and pay down the cost of that option while that option appreciates. So kind of a two-pronged approach. Then you might stay in it for a year or a year and a half. As long as it stays on an uptrend and you're able to manage your way through that, then that's a perfect opportunity. So why LEAPS? Stock replacement. That's the first easiest answer. Why LEAPS? So if you're thinking I'm going to buy the stock, when you buy stock, what is your objective? Now, if you're just investing in it, you're just going to kind of buy it, maybe set a stop and just let it go. If you're looking to more actively invest, so it's a little bit less than trading, a little bit more than just riding for nothing, then you might look to ride the swings from a monthly chart, or I mean a weekly chart. Is that market forecast tool available? Oh yeah, so sorry, this is just an old one that I sometimes take a look at. I actually worked with the guy who made that like 15 years ago, and I like the perspective, but it's just in the list of indicators. You can go find that. Let me go back one more time to a little broader chart. So you can see this is not something we tend to do a lot, like in the trading room or whatever else, because we tend to trade more than this. But you can see here, these are just like longer term opportunities, and you can see, look how much we've accelerated out of our trend. Let me go back. That is an interesting perspective. A leap strategy that I sell weekly options. That's it. That's calendar spreads. You buy long term and then you sell short term periods of time. Looking for those. I'm assuming if you do it weekly, you're just looking to have those expire worthless if possible. So small bits of credit, selling out the money, weekly options. Let's go 20-year monthly. Okay. And look at that. Look at that exponential acceleration coming. Oh, this is Tesla. Let's go to the market. Sorry, I thought I was on SPY. Not as bad, but still pretty bad. Yeah, like exponent. That was Tesla's gone crazy. Oh, that seems a bit priced in. So, okay. So here is the. I'm gonna actually pair this back out. This is the 3-year weekly. So same thing. What is this telling me? If I am a person who is looking for longer term position trades where it's like, right, instead of days to weeks, it's weeks to months, or investments. I mean, if you're investing, maybe you're doing a little bit of fundamental research to make sure that you've got a profitable company, sales growing, earnings growing, effective return on equity, a few core pieces of the fundamental puzzle to say, I like this, I like the sector, I like this as a leader. And now what? Now you're waiting for opportunity for getting in. Well, that would be showing up in a lot of things. What happens then at that point? Well, the first thing we do is we look to see what exactly are the options available. So make your way to an option chain, and from within the options chain, you're going to go in and basically see what does a stock have by way of expiration offerings. So if I come in here, I go in. Now this is SPY. SPY is going to have just about everything. It's got weeklies, 3 days a week. So if you notice here, I've got the days to expiration. So for me, right when I get around 6 months, 180 days or more, so you can see there's a transition right here, September, that's 240 days, 250, 300, 340, and it just keeps going from there. I can go all the way out and get 367 days. That's 3 years. 3 years if I wanted it. 2 years here. I mean, it's someone might ask, what's the benefit? Well, you're going to have less theta again, but there's going to be diminishing returns. Where if you look at, let's just say, let's look at the money. Well, let's go even in the money options. We'll go delta of 0.7. That's a pretty common thought process. So let's go, we'll start 1 year out, January. Let me get into singles and I need to go probably even deeper than this. 420, 415, 410. There it is. So right around there, my delta you can see is about. So if I have one contract, that controls 100 shares. Yes, like a standard option, it controls 100. But delta. Can I help you? Delta helps you to understand how does it behave. It doesn't behave like 100 shares. It behaves like 70 shares. That's what it behaves like. Well, on the downside, that's good because if it drops 50 points, I don't lose 50 points. I only lose 35-ish. Let's go about 35 below. That's 421. That's my stop. And you'll notice if I were to let's see if I can buy 1,000 shares or 100 shares. Buy 70. 2,500 in risk for 70 shares. 2,500. So you can see. Let me just show you again how this is a stock replacement strategy. There's my risk. If it drops to 421 on one contract, I'm going to lose $2,400. And if I buy the stock, I'm going to lose $2,500. It's actually $2,460. So those are within $40 of each other, right? So that's what I'm doing. Now the cost is instead of paying for 45,000 for a contract for 100 shares, I'm paying about 7,000 for one contract. So it's leverage. I'm getting 6-7 to 1 on that type of a trade. That's it. That's what you're doing. There's no secret to LEAPS. The secret is, can I get the same behavior for less money? Right? That's the objective here. Now you might say to yourself, that still might be too much. Well, you can definitely go closer to the money to change the delta, right? So if I only wanted 50 shares of this, then I'm only getting one contract, I need to go find a delta of 50, and that would be 50 shares. So if I bring that to one contract, that behaves approximately like 50 shares. So if I had 50 shares, I'm losing $17.95 versus $17.26. Again, that's what I'm looking to do, because now if I'm selling short-term premiums out of the money, let's say I'm selling 2 weeks out. 2 weeks, what would that be? The 28th approximately. 2 weeks out of the money. If I go out of the money to, let's say, 465s even, I'm collecting $3.40. Well, 463s. I'm collecting $3.40. That's almost 10% on the price of the option. It's less than 1% of the price of the stock. So that's where you're leveraging the long-term option to give you the ability to sell short-term options and not get hit, right? You're not going to get hit by the fluctuations because you know you're going to hold through it. As long as the trend is intact, anywhere along the way, you would have held. Doesn't matter where you bought it, you would have held it and possibly then sold premiums against it. And that's the I would say probably the most popular strategy involving LEAPS, other than just to get the leverage it offers and not lose too much in time, is the ability to leg into the diagonal spreads. So you can see at this point, if we're willing to reduce, sorry, let me go back, our position from a 50 share to a 70 share to a 50 share position, the cost is cut almost in half. Instead of paying $7,000, we're paying $3,700. $3,700 for 100 shares that behaves like 50, and then gives me the ability to sell premium every other week for a couple $100, right? You tie up 3,700, and then you go try to produce, I would say, at least 5 to 7% a month selling premium against that money, right? So if we were 2 weeks, let me go back up. This is only 10 days. This is only 10 days, and we could go, let's see, 457. If I wanted to make 10%, that's $370 a month. So let's say we did that twice. So I need to make 185. How far would I have to go for 185? Sorry, I'm just talking myself through it. Where's 185? So I could go out here, 467. So that's about 10 points out of the money, which is a little over 2%. I still want to try to, I don't want to put this on if it looks like it's bouncing to the upside. But if there's any question about the strength, and I put 2 of these on, I'm producing somewhere around $400 a month. And I am put capital down of about 3,700. So I'm getting, on that money, I'd be able to just without any appreciation at all. Now, if I'm able to get some appreciation, that makes the strategy even better. I am not a proponent of selling every week blindly. If the market's in an upswing, I'm more inclined to just hold the calls, wait until they get a little overextended, and then start selling again. So if you look at the chart, essentially you can kind of see these windows in here is where you want to tend not to. But once we get into these extended areas and downward areas, there is ample opportunity. Even when it's grinding higher, as long as you're selling out of the money, you'll actually be able to make significant. So if it's moving upwards, you want to give it a little bit of room. But once it gets to a certain point, covered calls, they can be at play. You can see for 8-10 weeks. If you're in the periods of heavy momentum, don't do it. So if, let's say you decide, you know what, Scott, I'm going to take you up on this strategy. I'm going to find a few good, strong stocks in leading groups. And when this turns, I'm going to get in. I'm going to buy it. Now, this is where you're entering, so your stop should be based here. So let's say it turns up like this, my stop will be down underneath here somewhere. That's when I believe the trend will have broken, if that's what happens. Just because you're long term doesn't mean you don't have an exit strategy. And if it turns and moves up, you're not going to do anything but hopefully watch it move up. Then when it gets into this area, or when it starts to drop again, which we see happens over and over and over, we start selling premiums for however long it goes. And then when it starts to turn, we stop and we let it go again. That's not a super active strategy, but that's a strategy that you can tie up larger chunks of capital and really still produce, pretty significant returns. You're selling the premium, and so you're benefiting from time decay. Your time decay and your volatility are always more favorable because you're selling the short term and buying the long term. That's it, diagonal spreads. So what are puts, or excuse me, what are leaps? What are puts? What are leaps? Long term, 12 months or more for some. For me, anything over 180 days. What do we do it for? Stock replacement. Instead of buying the stock, you're buying a leap. It's that simple. If you never buy the stock, you may never buy a leap. Or you might say, hey, you know what? I've been thinking about some longer term things. This seems up my alley. Why? Because maybe it gives you the ability to leverage yourself still versus buying the stock, a lot less capital tied up, still gives you the ability to sell those calls in opportune times. I mean, we want to make sure that we have some specific rules, but you'll notice you're managing this from the longer term, weekly. I don't need to sit and stare at it every day. If there's a bad day, you're not going to be like, oh, what am I going to do? Nothing. Look at it. The trend's still intact, right? The trend is still intact. You still have, and keep in mind that any of the times when these candles start to turn red, typically we see an elevated VIX around that same time. If the VIX is up, what does that tell us? That tells us that now the value has pumped into the options to some extent, and now allows us to sell the short-term options at a greater rate. So if you're looking for a strategy that involves positive time decay, a little less of a frenetic pace for trading, watch what we do in the trading rooms. It can be frenetic. You're in, you're back out again, you're waiting, you're looking to snipe a trade, versus something like this, where we can be a little bit, a little bit more passive. We're not staring at it. We really don't even have to look at it daily. I'd still take a peek, but this is the chart that you're using. If you're trading leaps, you're looking at this longer term chart. Otherwise, you got to ask yourself, why? Why did I buy the leap? What is it doing for me? Questions. Give me some questions. What do you guys think about the strategy? First of all, the buying leaps as a replacement, but still looking to leg into covered those opportunities. If you get 6 to 8 weeks and you get, let's say, 3 or 4 options at $2 an option, that's $6 or $8 that you paid. That $37 option pays down. If eventually, we end up at $5.50 and you have what was the option? I can't even remember the strike price. $4.60. So a little out of the money, right? A little bit out of the money. Your ability to produce income off of that is strong. How reliable is the slow stochastic indicator in predicting an upturn? Well, I mean, you can see for yourself. I like it. But your question is valid, and this is what I tell people all the time. It's pretty easy to test a system. Look backwards and say, where would I have liked to have gotten in? I would have loved to have gotten in right there. I would have liked that one. I would have liked that one. I mean, any of these little guys in here, this would have been great. Any of those. Now what? Now draw a line down and see, how did your indicator do? Pretty good, right? Any of these little pullbacks, typically pretty good. Not quite on that one. Not quite, but it turned. This one here, this one here, this one here. And you can see over and over again what happens. even going back. What happens afterwards? Well, that sometimes it doesn't do as much. Sometimes it does more later. But yeah, this is significantly. Now, that's a great question. So Jeff said, how soon prior to expiration should the LEAP be sold? And you know what? It's going to depend, because if you catch a good move, you may find that it's moved so far. Let me show you what I mean. I need to visualize this. So let's look at this option here. Let me give you some perspective. Okay. Now, if you got in this trade, time works against you right here in the middle. If this, let's say that over the next 6 months, the stock market made a 20% move up from where it is right now. Okay, so right now we were at 457, and we're up 20%. That's huge. That's 580, right? 20%, you're out here. Now, if it gets out to 580, your theta is down to 2. You're losing less there than you are now. You're only losing $2 a day. So for $2 a day, if I thought there was more bullishness, would I continue to hold it? Absolutely. So it does depend on how the trade starts to behave. If it moves, the more it moves, the less time influences, the easier it is to continue holding, where you're like, hey, I bought this, I caught a trend, I'm going to ride it, because eventually it's all intrinsic, right? It would all be intrinsic value. If it gets up here to 580, this option has $120 of intrinsic value, period. That can't be taken away, right? So a trade like that, and you thought there's another 10%, that puts it up here. You're gonna hang on and just say, hey, I'm gonna sell some premium, out of the money premium, keep paying for it. Let's give it another 6 months to see if we can get 10 more percent. Something like this, that makes that trade even better. If it stays in this range where it just doesn't move, then you would look to probably roll the trade or just shut it down. But rolling would be rolling it out. You sell what you have because it's starting to accelerate in the way that its time works against you, and then you go out and you buy the next one. So let's say, and in that regard, I would say before 6 months. I think, if you're in it after 6 months and you've used half the time, and that's what I would say. So if you bought 6 or 7 months, I'd say after 3 months, reassess it and see if it's time to roll it, because you need to go further out. So that would be my answer. I would evaluate it at the halfway mark, and as long as it's gone the right way, you're going to find that the time situation's gotten more favorable, and you're very comfortable staying with the trade. And if you do that and the trade stays good and that trend continues, you can go ahead and manage that all the way to expiration, selling time premium every step of the way whenever the opportunity presents itself. Yeah, that's a great question. So, but if at the halfway point you're looking at it and the trend hasn't developed, and you've probably been able to still do okay selling short-term time to offset what you're losing on your long-term option. Maybe not necessarily produced a lot, but at that point you'll be like, you know what, I'm working hard here for 3 months or 6 months, and I've hardly made any money, or I've broken even. Yeah, but lost, but yeah, that's not what you're trying to do. You're not trying to break even, so you move on to something else. So yeah, I would say if you don't use, you want some indicator that's going to turn, an RSI, a stochastic. Remember that you can even come in. Let's go SPY, and you can go to the longer term. Let me take this out. And you can kind of get a sense here where you're like, hey, the predictions are still in my favor. This looks good for a move. This says up to like 520 over the next 6 months. 520 in 6 months. We're only here. So if I did that, after 6 months, let's go out to somewhere around June-ish. I mean, it's lost. If I mean, as long as it's made a move up here to 520, then I'm still making money. I've lost in time decay, but I'm making money here. Hopefully I've sold some premium, and then I would decide, do I think it's going to keep going? Then I have time for it. If I think it's going to settle in this range, then I'd probably push out and go a little further in time. And then, again, what are you using for when to sell options? I'm still going to be looking at this longer term. If I'm overbought, or I've turned, those are the times where you can see when I get into this range, this one really turned, maybe it pinched right there. And if I started selling covered calls here, it went a little higher, dropped, I would have been able to get 6 to 8 weeks of it. You're just basically, if it's moving higher, you want to let it move higher. When it starts looking like it's hitting some overbought and possibly consolidative areas, then you look to sell some premium. Eventually it'll bite you. You'll have to buy some premium back, but that's the basic strategy. Diagonal spreads coming off of LEAPS as a stock replacement. You don't have to. If you're just looking to replace the stock, you buy it, you hold it. It's a long-term thing. It can do quite well. I mean, you can see that if I did start with a stop loss at 421, and I did have a 20% price target, which was, where was it? I forgot. 570, 580, 580. I mean, at this point, I would say that after the first month, we would want to have moved our stop up at maybe 2 months. Let's go back to February. I don't think the risk would be quite that high. You can see here. So we should be getting at least 2 to 1 or more on our money. I believe that the ability to sell premium is what makes this viable as a strategy. So if you're selling naked puts and selling covered calls on equities, that's a great income strategy. But if you're not looking to tie up that much capital, I would say diagonal spreads is probably the next best thing. They're really easy to be consistent with this. So, all right. Well, any other questions? With what I know, you should not rely so much on future projections because so much going on behind the scenes, which most aren't aware of. I have no clue what's coming down the pike. I mean, we got to rely on something, right? Here's what I know. I know the institutions know more than I do. They have more. So regardless of what's coming down the pike, at any given time, what we know is this: there's a full labor economy right now. 170 million people contributing to 401ks, getting matched. Companies are making money. 403bs, right? Pensions. All of that money is going into the market every week. And the institutions have to put it somewhere. So for the most part, they're going to. Until something happens catastrophic enough that those people stop their contributions and they just put their contributions to cash and they start liquidating their 401ks, and it takes a lot to get there. So it's an interesting thing because you're in the market. You start thinking, well, everybody's looking at this, right? Nah, man, most people file their statements before they even open them. So here's what I know. The trend is strong. Things in motion tend to stay in motion. I know that I can get great insight into institutional sentiment. Are they hedging? And I look at this and I think a little, but nothing coming, nothing like this or even this. It's down here. So as of right now, what am I relying on? I have to rely on something, right? Either you're going to speculate and rely on something or you're not going to speculate. It's that simple. So what do you rely on if you're speculating? So you're typically going to rely either on fundamental data, which changes every 3 months with earnings. Other than that, we all know. Maybe it changes as analysts change their recommendations, at least temporarily. So you either rely on the fundamentals or you rely on the price, or both. Price for me, right? Charts, trends, support and resistance, volume, so that it's not always about being right, but building the right trade in addition to trying to be right. If I get 3-to-1 on my money and I'm only right 50% of the time, I'm a happy trader. If I'm only right 40% of the time, still a happy trader. If I have variables working for me, like time decay, the most consistent variable there is, that's going to help improve my probability, right? So strategies where I'm mitigating time decay against me, trading strength, strong stocks, strong industries, strong trends. Yeah, you're right. I'm going to rely on projections. I'm going to rely on support levels holding. If they don't hold, I'm going to close my trade, take my loss, keep it small, wait until I get signals again. Right now, not a lot of trading. If you think you have a setup developing on a longer term trade, that means the short term's been a little volatile, a little choppy. And that's what we've seen. So our trading activity has been lower. Of course, right? We have no idea what's going to happen with the Fed. 3 hikes, maybe 4, maybe 5. First one could come in March. Certainly anticipating the Fed will cause the market to shake around a little bit. Omicron, we don't know. Are we burning through it? Are we going to be okay? What's next? Are we going to see shutdowns? I mean, the French came out with some crazy vaccine law. We don't know about that. That's basically it, though, right? The pandemic and inflation, those are our problems right now. Real estate's fantastic. It's gone great. A lot of equity out there from real estate, actually, enough that it could potentially pose a problem. Jobs are great. Everybody's working. There's plenty of jobs out there. Wages have come up a little bit. That's just fine too. What's not okay? Inflation, highest we've had in a while. That's not good. Fed's going to have to do something. What are they going to do? They're going to taper their quantitative easing, and they're going to raise rates, which makes it harder to get money and more expensive to get money. And that's going to certainly put a damper on some things. So it cools things down. Okay, that's our environment. What does the trend tell me? Trend tells me everything's still okay. Short term, a bit choppy. I'd like to see a little more dust settle. Long term, trend is still good. If we see it turn, there is long-term opportunity. If you're not interested in long-term opportunity, well, I hope you enjoyed today's presentation on LEAPS, but you'll probably never trade them. There's no place. If you're not trading long-term, if you don't need stock replacement, then LEAPS are not for you. If you've been thinking, I'd like to have something a little more stable, a little longer term, where I can sell some premium, I can hold, I don't get shook by all these little blips that the market goes through, right? When you see those blips here, they're not here. It's like, oh, I don't want to have to hold through this. When I look at it here, I think, yeah, that's fine. Especially if I started selling premium back here somewhere. I said, oh, let's just start selling some premium and see if I can hang on to this thing. And then when it turned up back here, we stopped, started selling premium again here, and we've been selling premium, I would say, for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks in a row. So 6 trades. I mean, those 6 trades alone could pay for a third of the cost of your LEAPS that you bought. So if you have 4 or 5 windows like that, you're profitable on the LEAPS just from selling, let alone what the LEAPS are worth, especially if the intrinsic value is increasing. Okay, I hope I answered that. You got to rely on something, so pick your poison, and then live with it, and then decide if you need to evaluate something else to rely on. Yeah, I'm going to rely on price. Price tells me just about everything I need to know. I've got some models, right? Tradespoon model to help me out. If things start to get nasty, the volatility will spike. I'll dial back my trading and watch it. So am I aware of what happened on Tonga? Yeah. I am. And the market saw it, and the market processed it, and all is well, right? I mean, if you know, events like that have you spooked, yeah, then you're right. You probably shouldn't trade. I'm not here to convince anybody to trade or not to trade. I'm saying have a plan. Right? Have a plan. The if the market gets nervous, what'll happen? It'll break support, break a moving average, volatility will spike, and I'll look to trade puts to the downside. You know, find a reason, slap it on. We've seen things come and go. You know, it's at the end of the day, life will continue to go on. People will continue to be employed. Companies will continue making products and services, and you know, we'll deal with the other things as they come. Right. So, what role should liquidity play? I mean, for me, a huge role anytime, because if you're going to be selling short-term premium, you want to know that A, they'll have weeklies, that B, they'll have enough weeklies that you can sell as far out of the money as you want, that you're going to keep as much of it as you can. So the more liquidity, the better. Another phenomenal question, Jeff. Yeah, the if you have questionable liquidity, the LEAPS will have a little more spread, which you can probably live with. You can probably cut it in half. But when it comes to selling short-term premium, if the liquidity is questionable, you're going to feel it. And there's just going to be a little extra going to execution costs. You're paying a little bit more. I mean, you know, so I would ideally say I want a leader. I want, you know, 5 million shares trading, stuff like that. Yeah. Yeah. Nothing thin, nothing thin. Whatever, if it was thin when you got into the LEAPS, it would only be worse. It would only be worse when you got to wanting to sell some short-term premium against it. So there you go. Great questions. Yeah, there you go. I am long-term bullish. The I am bullish overall, and I am you know, with strategies that I do that are longer term, I am definitely looking at what's happening right now as a potential setup. So there it is. Okay. Well, it's good to see everybody. I'm glad you decided to come and hang out with me for a little while. And I appreciate it. I will see some of you tomorrow in the trading room. I will see some of you in 2 weeks for the next one of these. Either way, I appreciate you. Have a wonderful rest of your day and week. And as always, happy trading.